Hello friends, Namaskar. Welcome all of you to my channel. Today let's discuss about the income measurement and accrual accounting, for which I've taken the reference of Porter Norton 9th editions, that's a financial accounting, the impact on decision makers. That content you will find in the page number 152 to 169 friends. Now based on this small background, what we are going to discuss today, this is all about your overall content friends. I would discuss about the recognitions and the measurement first of all. Then I will talk about the what about the cash and accrual basis of accounting, and then we will discuss about the journal entry analysis and what about the adjusting interest friends. Now let's talk about friends. That's all about recognition. So when we say that recognition, simply you can say that is the formal process of recording an item like assets, liability, revenue, expenses in the financial statements. And what about the measurement friends? Measurement, when we say that, that's assigning the monetary or other quantifiable, that is the values in economic events, which is simply it could be uh, based on the historical cost or fair value, we say that. And you could see this is the our economic event like your purchase of supplies, sale of product, payment of wages, warehouse fire, and many other events, and recognized with words like your cash, land, and is the numerical value, we say that, and is the measure with the attribute, that's the historical cost, and the unit of measure is the dollar friends. Now let's talk about the what about the cash and accrual basis of accounting friends. So it's all about this is one example which help you to understand about the cash and accrual basis of accounting. Basically this is all about friends, cash basis when revenue is recognized when received, while cash under the cash basis again expenses is recognized when paid it, while in case of accrual basis friends, we like your revenue is recognized when earned, and the expenses is recognized when incurred. That is the that is point you need to understand here friend. That's all about your comparison, comparing the cash and accrual basis of accounting. You could see this picture. This is the picture of related to your pending of house, and we have a contract is signed on July 14. This is based on this example, and here during the signing of the contract no revenue yet, while on this date house is painted, and when house is painted still payment has not been made by the customer, so this is called accrual basis. Okay, but at the same time after 30 days when the customer paid, that means customer pays for job, then that is the cash basis when cash is received. Now let's talk about its effect in accounting equation, including the let's discuss about your journal entry analysis. So in this case, as stated in this, you could find this one in picture also. That is on July 25. So you'd have a journal entry. We see that account receivable, those who painted the house. So account receivable to service revenue, we say the account receivable from the customer, we say that. So this is based on accrual accounting system, we can say that. So look at your balance sheet. So asset account receivable is the current assets, and since amount will be received after 1 month still, but still in income statement we say that you would have a sales revenue, so your net income is there. When we have a net income, it positively affect the stockholder equity. So this is the 1000. This is accounting equation friends. Yeah, balance sheet you can say that. So on August 25, cash uh, cash received. When the cash is received, then your journal entry would be simply cash account debit to account receivable. So in this case, cash inflow is there 1000, while account receivable would be reduced by the same amount, because on this date July 25, that is the amount to be received, while August 25, and we that's account receivable would be reduced by the 1000. There is no any impact in the income statement, friends. So let's talk about what about the comparison of the income statement and statement of the cash flow, friends. So this is all about this is the income statement, okay, where this is the like a revenue is the membership, code fee, and expenses, salaries, wages, utilities. So you would have a net income of the $7,000. Now what about the partial statement of the cash flow? So in this case, cash from received from membership fee, code fee, and cash paid for salaries, wages, and utilities part. So cash used by the operation is the 4,000 minus figure. Okay, this is simply understanding of the comparison of the income statement and statement of the cash flow. Now let's talk about what about the case of revenue recognitions principle, expenses recognitions, and the matching principle. So revenue are recognized in the income statement when they are realized first, or realizable, or earned. 3 points that you need to understand: realized, realizable, and earned. And what about the expenses recognition? So under the matching principle, friends, we can say that accountant attempts to associate revenues of a period when the cost necessary to generate those revenue. To generate the revenue, we have to um, spend to for having the, we can say that revenue. So we can say this is matching principle. What, so the we can say that, friends, is a classic example could be like your example of direct matching of the cost of goods sold expenses with the sales revenue. Okay, so the cost of goods sold here is the cost of the inventory associated with the particular sales, we say that. Okay, now let's talk about what about the how we could compare the three methods of matching cost with the revenue. Look at the first case, like your purchase of merchandise. Purchase of merchandise which is related to merchandise inventory. Now office space which is related to office building. And next one is that heating and lighting which is related to the that's utility expenses. So the cost incurred for the purchase of merchandise result in the assets, merchandise inventory, and are eventually matched with the revenue at the time of product is sold. Yeah, cost incurred for the office space result of an assets, yeah, office building, which is recognized as the depreciation expenses over the useful life of the building, friends. Now, and third one is that we discuss about the cost of heating and the lighting benefits only the current period, and thus is recognized immediately as a utilities expenses. Now, friends, let's talk about individually accrual accounting and adjusting interest, friends. So first case you need to understand here, that is the cash paid before expenses is incurred, that is the is called as a deferred expenses. So in this case you would have adjusting interest. Let's talk about the for insurance policy here. So September 1st we have a prepaid insurance to cash, we say that. Simply this is the case of, you can see this example is the 2400 for insurance policy. So in this case your balance sheet, yeah, simply you can say that assets equals to liabilities plus equity. So prepaid insurance is our being the current assets is the 2400, and the cash outflow is there. So is the cash is the minus figure 2005 400. Okay. Now what about the case of this case when we recognize 200 of insurance expenses for the month? So in this case, insurance expense account debit to prepaid insurance. Previously, it was prepaid expenses. Now, when we recognize as expenses, so insurance expense to prepaid expenses 200. So simply you need to understand here, prepaid insurance would reduce by 200, and your, since this is insurance expenses, so net income is negative, which causes stockholder equity is also negative. Now this is the T account that you need to understand here. That's a prepaid insurance is the 2400, and this is the 200 is the, so you would have a net is that a 2200, friends. Okay. Now let's talk about what would be the case of let's see the understand about the recording depreciation, friends. So let's see the in this case the is by the new store fixtures for 5,000. So this will be the case of your, this is being the assets, store fixtures to cash, we say that. So store fixtures is the fixed asset. So 5,000 cash outflow is there, is 5,000, we can say that. Now when we talk about your depreciation, friends, so depreciation expenses to accumulated depreciation. Now you might have question about how this $75 has been calculated. Simply you can say that if we have a straight line approach of depreciation, so 10% of this 5,000 would be simply 500. Okay, so 500 means if we assume that its life is the, simply we say that, friends, is the 5 years, so monthly would be is the 5 into 12 months in a year, so is the 60. So simply what you do here, we can do here, friends, simply we say that is the 4,500 divided by 60 months. Okay, so 75 amount is our depreciation. So in assets that will reduce like you can say the provision for depreciation or accumulated depreciation 75, and depreciation expenses is there, so is the net income is negative, so you would have a stockholder will be negative, friends. Okay, now let's talk about, yeah, this is the T account you need to understand here. So in balance sheet, when you look at the store fixtures is the 5,000 while accumulated depreciation is the 75. So this is your net value of the store fixtures which will be reported in the balance sheet, 4,900, that is the 925, friends. Now let's talk about yeah, what will be the case of cash received before revenue earned, which is known as the deferred revenue. Like cash insurance collected in advance, like insurance company collected insurance premium from the customer. So in this case, cash account debit to insurance collected in advance 2,400. So cash being the current assets component, so we say that cash 2,400. While when the insurance company collected advance from the customer, so that will be the liabilities for the insurance company. So this is 2,400, friends. Okay, but now let's talk about when the insurance company recognize the insurance service earned for the month. So in this case, like for September 30, so insurance collected in advance to insurance revenue, we say that. So in this case, your liability insurance collected in advance as a liability will be reduced by 200, and since this is your revenue, so it will be the positive effect, net income is positive. Okay, now what about the case of expenses incurred before cash is paid? Yeah, accrued liability. Yeah, simply you can say that. So in this case, let's talk about the journal entry analysis I'm talking about. Like June 14, this is the wages expenses to cash, we see that when we pay the wages expenses. So the payment, for payment case, because of being the nominal account, we see that wages expenses to cash 2,80,000, friends. Now yeah, in this case cash assets will be reduced by cash being the current assets 2,80,000, while wages expenses, so you would have a negative net income, so stockholder equity will be negative, friends. Okay, now what will be the case of next one, friends? So in this case yeah, if we say that wages expenses, when we record the outstanding wages, we say that. Okay, then wages expenses for to wages payable 40,000. So in this case, friends, wages payable, it has not been paid, so this is simply we accrued liability, we can say that accrued expenses. Okay, wages payable 40,000, and so is wages expenses negative net income, so you would have a stockholder is 40,000 negative. So at the same time, there might be the case on July 12, yeah, sometime we paid it wages expenses 2,40,000 and wages payable is 40,000. When we record in the compounded entry, we say that. So in this case, cash will be reduced by 2,80,000, wages payable 40,000, and stockholder equity will be reduced by 2,40,000. This is the case. Okay, now yeah, this is the case of your Yeah, accrued liability, we see that. Now what about the case of next one? Yeah, there might be the case of we can say that notes payable. So is the to record issuance of the notes 9% 90. So in this case, cash account debit to notes payable, we say that, friends, is 40 is 20,000. So is the notes payable, cash is cash we generate is the for 20,000. So at the same time, when we pay the interest, uh, when interest payment is there, so we say the interest payment to cash. But at the same time, when is the interest to be paid, that is the case, interest expenses to interest payable account, friends. So this way we record it in accounting equation 2. Then let's talk about what about the case of today we discuss about the so many things. Now let's talk about what about the accrued assets. Accrued assets is like your rent receivable, we say that, rent to be collected. So in this case, rent receivable to rent revenue, we say that. So in this case, rent receivable is again current assets, and yeah, that's based on accrual accounting system that will be uh, generated, which causes the net income 2500. So his equity will be 2500, friends. Okay, friends, today we simply discuss about the we discuss about the different concept related to, we discuss about the recognitions and the measurement, cash and accrual accounting system, journal entry analysis, and more important we discuss about the adjusting entry, friends. Okay, friends, these are the things that I would like to share today. If you really like this content, please like, subscribe my channel, that is the Finance Guru, Pawan Kumar Jha. Thank you all of you for watching this video. Please take care all of you. Thank you.